Well, good afternoon, everybody. My name is Greg Reimer, and I'm President and CEO of Surge Battery Metals. And welcome to our webinar on our recently issued preliminary economic assessment. Today, we've got a great panel to present the PEA to you, and I'd like to introduce them. We have Howard Klein and Rodney Hooper from RK Equity, and they're going to act as our moderators for this session. We also have our board chair, Graham Harris, our senior project engineer, Graham Balachi, and we have Steve Terrian from 3L Capital. So to begin with, I'm going to turn things over to Rodney. Rodney, go ahead.
Thanks very much, Greg. Just to cover what we're seeing in the market and the future of supply and demand, it's been a difficult market to read because from our perspective, demand in each of the categories has exceeded our expectations, and yet prices remain muted. I think it is important to recognize and understand that in the longer term, electric vehicles' share of total addressable market is smaller than we first envisaged, and there are a lot of other sectors that are going to require lithium-ion batteries, and some of them at exceptional growth rates, in particular battery energy storage. And I think looking at it in that context and recognizing what the total addressable market size is going to be going forward, one understands how sensitive and vulnerable some of the suppliers in the market are in terms of meeting that demand. And we see that through the discussions that we have with various clients and with market participants about inquiries and interest they have in offtake agreements, which suggests that the doom and gloom is overstated in the medium term. And I think it's important, if one looks at some of the bigger players coming into the market, and the interest is in long-term projects that can offer secure supply. And as the dynamic shifts away from China inevitably to other parts of the market, we're likely to see that secure supply chains from various jurisdictions are going to be needed, and they're going to want big resource projects rather than stopgaps that we're seeing from various parts, including Africa, in the short term. So we see demand, to repeat, it is exceeding our expectations again this year and likely to continue. And at some point, supply volumes are just not going to meet the large numbers that are going to be required. And then which assets, geopolitical issues going on around the world are suggesting that the various different regions would do well to lock in very specific critical minerals in their own jurisdictions. And I'll pass it to Howard to cover the US and his thoughts.
Okay. Well, the US, has had a change of administration, but they did approve 2 large loans to sediment deposits, the government, that is, in Lithium Americas Thacker Pass and Ioneer's Rhyolite Ridge. In Thacker Pass's case, a $2.23 billion loan. In Ioneer's case, nearly $1 billion. And in both of those cases, they attracted strategic partners, GM in Lithium Americas case, and Ford and others in Ioneer's case. So within the context of U.S. supply, what's been getting funded and is now in construction, at least, is Thacker Pass, Lithium Americas, and Tesla. Elon Musk 5 years ago during Battery Day said there's enough lithium in all of Nevada to power all of the electric vehicles that the U.S. will need. But it's now not just about electric vehicles, but it's AI and data centers and energy storage, batteries, backup for solar and wind power. That's exceptionally needed, as are batteries for military applications like drones and robots. So as you said, Rodney, the EV demand might be less, but other applications are increasing, and the geopolitics of you see it today. Trump and Xi have a deal, but the headline was, we got our rare earth magnets, right? And and we'll barter that for Chinese students. So mining under this administration and critical minerals, are very important, and lithium is part of that dynamic. And it's projects like Surge's are important. They're relevant, and Nevada is a great place to build mines. So with that, I'll hand it over to who's going to lead the discussion on the PEA.
Graham Harris is going to kick things off and give a summary of the PEA, followed up by Graham Bellacci.
Thanks,
So
Graham.
you, Graham
Thanks,
Harris.
Rodney. So we can hit that slide. I'd just like to say that, I've been fortunate in my last 10, 12 years in this business to be involved in lithium projects. And I'm very excited about the PEA we were able to announce. I've been involved in a PEA before with Millennial Lithium. And I can honestly say that this one is much, much better than that one. And that one was sold for 500 million to LAC. And I think this one will garner people's attention. It's 9 billion after tax NPV, 9.21. It's a great IRR of 22.8%. What's really important in the PEA is it's a 4.7-year payback, which is half of what our comparable claystone companies are. We're using what everybody else has used, and SGS has given us is a price assumption of $24,000 a ton. And we know it's not trading for $24,000 a ton today, but do remember that's based on the 40 years of mine life, what the expected average is to be. The phase 1 capex, similar to other projects, 2.97, with phase 2 coming in for another 2.35 billion, total capex of 5.32 billion. Our OPEX is key here. It's $5,097 a ton LCE, which is significantly lower than our peers. And a lot of that has to do with being the highest grade and being an at-surface deposit. So we're excited to share that with you. Our average annual production is 86,000 tons, peaking at 109,000 tons in year 6. And I'm very happy to have and introduce today Graham Bellacci, who's been working as our project engineer, who's been working on this daily for the last year. And I'm going to ask Graham to take us through some of the highlights of the PEA.
Thank you, Graham. We can see the next slide. So here we have, this is the Nevada North Life of Mine Mining and Production Parameters. Before we get into it, I'd just like to thank our lead consultants on this were M3 Engineering and Technology Company, and who did the mine design was Independent Mining Consultants, both out of Tucson, Arizona. They did a really great job. So here you can see we have a mine life we've designed of 42 years, but we're only using 31% of the resource. So there's potentially more. Overall, we're mining 443 million tons, and that's at an average grade of just over 4,000 parts per million, which is considerably higher than comparable claystones. The peak year, which happens in year 6 because of the shallow and high-grade mineralization we have in Nevada North, occurs in year 6 at 4,807 parts per million, and that beneficiates, after the beneficiation process, I can explain more, to just under 6,000, which is very, very high for a claystone. The total amount of recovered lithium carbonate over the 42 years is 3.63 million tons of lithium carbonate equivalent. That works out to an average of 86,300 over the production years. We've got a high recovery at 82.8% of the lithium. And compared, the total amount mined is 443. That splits up into 205 million roughly of the mineralized material and 238 million tons of the waste. So we have a very low strip ratio, just over 1.16 to 1. That's the amount of waste compared to the amount of actual minerals. That's considerably lower than most other claystones as well. This is a very blessed project in that way. Next slide. So here we see this is the OPEX breakdown. So out of the total of, actually it should be 5,097. So that's early. We've tweaked it since here. But you can see that the vast majority, 84% of that is in the lithium processing. The mining and the tailings do not cost very much at all. We're talking 13% of the overall OpEx. The G&A is pretty low as well. And but the lithium processing, which includes an acid plant and the acid leaching, followed by impurity removal and the production of lithium carbonate, the reagents and energy involved there, come actually at a very low 5,097. This is, the lowest of the clay stones that I've seen, and I've worked on several of these. Here we have in Nevada North, a very conventional sulfuric acid flow sheet. So you can see I'll quickly walk everyone through what this is. Maybe not in grand detail, but in the top left, you see the lithium minerals coming in on the top left. There's a beneficiation process, and what this is we mix up the clay stone. What we want is the clay, and we reject things that are not clay. And we try to recover as much lithium to really get the grades up prior to leaching. And that requires spinning it around. What we use is Sepro's Falcon concentrator, and we get about a 25% boost in lithium grades, recovering about 92% of the lithium overall. From there, we go into a sulfuric acid leach, and then we adjust the pH upwards. So bring it down, bring it back up, and impurities come out. And then we crystallize out magnesium and eventually go on to lithium carbonate precipitation. And from there, we get a very high purity lithium carbonate. And then in a subsequent refining step, we get to a battery grade lithium carbonate. And that's what's modeled as our selling product in this PEA. Here's our production profile. So the green bars, they represent the total amount of lithium carbonate produced in each of the production years. There's 42 production years in total. There's a ramp up schedule. So when phase 1 occurs in year 1, we start off at about just under 30,000 tons, but then very quickly we're up over 50. And then by year 4, we're bringing on phase 2. So very quickly we jump up by year 4 to over 100,000 tons of lithium carbonate. And that continues for quite some time. What these horizontal lines are showing is on the right side of the graph, the lithium grade being mined and the lithium grade after beneficiation before it gets into the acid leach. Obviously, the higher grade is the line after beneficiation, the top one, and the orange line there is prior to beneficiation. So we stay, if you look on the right, we're up at the near 6,000 ppm mark for almost all of the first decade. It drops off, and then towards year 30, we actually encounter some deeper material that's higher grade. So our grades start to come back up again towards the back half of the mine life. It's quite exceptional. So in this case, we're only looking at about 31% of the total resource being used. This is the best return on investment. But as market conditions change, we'll look to either expand that or whatever needs to be done there. So in terms of recovery, 82.8 is very high. The only significant losses are in leaching. We get about 93% of the recovery. In beneficiation, it's about 92%. So right there, that's about the 84% overall. And then there's just a little bit of losses in the further downstream processing. So overall, we get a considerably high recovery of 82.8%. In beneficiation, right now, we took a crack at it last fall, and we got it to 25% in a grade boost. We plan on working further on this. I've worked on other claystones before, and comparable claystones can get 40 to 50% increases in grade. And so that's something we plan to pursue is improving that metric right there. And these are the areas for further optimization that we'll be focusing on. So as you can see here, we have a base case here of 24,000 in the middle, and we think over the mine life that will be in and around the average or better. So that results in NPV of 9.2 billion, internal rate of return of 22.8. So really solid metrics at our base case. We want to show the full range of sensitivities here. So we go as low as 15,000. We still have a positive NPV of 2.8 billion, an internal rate of return of 13%. If you go all the way up to $33,000 for lithium carbonate, it gets considerably better. We've been at that price before. It's possible. $15.4 billion and 30.6% IRR. Exceptional.
Okay, Howard, over to you. I think you've got some questions.
Sorry,
You're
I
muted.
was I was muted. Sorry about that. Yes,
Okay.
sorry. Yeah, we have a couple questions from some of the participants here. I'll go through. The PA prioritizes processing of the shallowest and highest lithium grades. Could you walk us through how this decision impacts early project cash flows and the payback period?
Yeah, for sure. And we looked at a variety of different scenarios, and we decided that we wanted to get the best return on investment, and that just seemed to be the best thing for the shareholders. And this project made that easy because the highest grades are right at surface, and it made that really easy to prioritize so that we were able to get a very quick payback. And you see a lot of production in those first 10 years, allowing us to pay off the capital very quickly. And then it becomes a race. Do you want to go after the shallower material, or there is some higher grade material that's a bit deeper? And the mining engineers did a great job in figuring out the best way to do it. And that's why we see that increase in grades towards the end as we encounter higher grades that are a bit deeper.
Okay, great. And the next question is the average grade of the mineralized material mined is 4,016 ppm lithium with a peak of 4,807 ppm. How significant are these grades in the context of lithium clay projects globally?
In terms of lithium clay, it's the highest I've ever seen, and by a wide margin. Comparable projects that are considered high grade are more around the 3,000 mark, and this is 4. So it's a notable increase, and it makes this a very special claystone.
Okay, so in general, grade is king. So you're 25% higher than the highest projects.
Yes.
Okay. The PA outlines a life of mine strip ratio of just 1.16. How does this low ratio affect your operating cost structure and mine planning flexibility?
Well, it really just makes it for cheaper mining, which, as you saw in the OpEx breakdown, that's not the biggest contribution, but it is a considerable contribution. And the cost of moving waste around and stockpiling waste is also very much minimized on a project like this. And I'll even say we found, and we had a nice little surprise at the end, that it reduced our water consumption because we don't have to mine all the additional waste, and that really makes this a much more efficient operation.
Okay, great. And another one, the use of the Falcon C concentrators to boost lithium grades by an average of 25% before leaching is highlighted. Could you explain how this beneficiation step improves overall project economics?
Yeah. So as I mentioned before, the beneficiation step is rejecting minerals we don't want and concentrating the clays that we want to leach. And what that really does is allow us to be a lot more efficient with our acid usage, which is the largest input to the costs. The more lithium that's in that material that gets leached, the more that acid cost gets spread out over the product that we're selling. So it just lowers the OpEx directly and allows us to have a better return on investment. And the cost of that beneficiation is quite minimal compared to the savings we get in acid. So it became a very obvious thing to do.
Okay, excellent. And the next questions are more kind of comparable and capital markets focused. So Steve at 3L Capital, the Nevada North Lithium Project, with an after-tax NPV of over $9 billion and 42-year mine life and low operating cost, compare very favorably to other lithium clay projects. Given your experience in the sector, how does this PA stack up versus some peers in terms of economics, grade profile, and development timeline?
Sure. Yeah, thanks, Howard. Yeah, put together a few slides that we're going to bring up. And these tables and the figures that you'll see in the corresponding slides were in a 17-page report that I wrote about this project and comparing it to other clay projects and where it fits in kind of in the global cost curve. If you're interested in that, you can check it out and sign up for the research on our website. But anyways, yeah, so this is a table that shows a comparison of Surge to some of the advanced developers in the clay space. So Surge is at a PA level, LAC is at a feasibility, Jindalee, PFS, Century, feasibility. You can see the price that everyone's using is similar. you can see Surge's 9.2 billion NPV stands out as kind of the highest. The IRR is high. We talked about the CapEx. If you look at the OpEx per ore ton, that it's quite comparable to other projects, and on an OpEx per ton LCE, it's very very comparable and competitive. Some of the other projects you have, credits coming in from things like boron, like at Ioneer. It's got a quick payback compared to the other projects. Average production is right up there. The strip ratio, like Graham mentioned, is low. One of the best NPV to CapEx ratio, and obviously that's a moving target depending on what price you're using, but everyone's kind of using the same price. And then when you're looking at kind of the capital cost per installed capacity, with that capital cost and the average production, you kind of divide those out, and Surge is I would say in the lead in that category. And if you go to the next slide. Yeah, so I've done a bit more comparison of this versus Thacker. So obviously Thacker has a much longer mine life. They'll produce a lot more tons in their plan compared to the PEA. But you can see, lithium grade, Nevada North looks really well. It's about 58% higher than the mine grade at Thacker. Lithium recovery is higher right now. Obviously, there's more work to do. But if that stays consistent, that's another one that looks quite good. Again, on the OpEx per LCE ton, very comparable. Good operating margin. And one of the things that Graham mentioned about M3 kind of being one of the leads on this tech report, they were one of the leads on the 2022 feasibility for Thacker. So they obviously know that project well. They know the cost. And if you go back to that last table, you don't need to switch now, but you'll see, the costs are definitely in line with Thacker and other projects. So I think they're numbers that you can trust. If you go to the next slide. So this is a comparison of Nevada North to Thacker Pass on a couple of different metrics, 10 years, 25 years, and life of mine. The table on the left is the first 25 years. So if you look at the 2024 Thacker Pass feasibility study, they kind of broke it up into the first 25 years and then life of mine. And so I went through, with some guidance from Surge and calculated what Nevada would work out to if it was just a 25-year mine life. And that's what those numbers on the left are. So you can see, the grade, Thacker's early grade is higher, but so is Surge's. Your average production in those first 25 years for Surge is 91,000 tons of lithium carbonate, Thacker Pass 125. Your operating costs are below $4,900 a ton in the first 25 years. Your strip ratio, it's a bit higher at the start of the mine life, and that's probably going back to what Graham was saying about kind of the trade-off, whether you mine the stuff that's outcropping at surface or do you remove a little bit of waste to get to some of that higher grade material that's just below surface. Before I get to the data before that, if you switch over to the top right, you'll see that those are the first 10 years of production. So Surge is in purple, Thacker Pass is in light gray. So in the first 10 years, Nevada North should produce around 200,000 more tons than Thacker. And then if we go back to the bottom left, so what I looked at is, here's the inventory that's in the PEA. You look at the resource table that I have there. The black is the reported outline, is the reported resource at 11.2 million tons. The red, the 7.43 million tons, that's at a 3,000 ppm cutoff. So if you subtract the inventory from the PEA, from the resource above a 3,000 ppm cutoff, you still have another 3.5 million tons of LCE, about 2.5 after the 82.8% recovery. So what does that mean? If you look in the lower right, you'll see the production profile and grades for Thacker and Gray and the current PEA for Nevada North and purple, that yellow box, that's, if you mine the rest of that difference, that's kind of what it works out to. So another potential 30 years of mine life that's not included in PEA. And if you kind of calculate what the residual grade of that would be, it's still very high, about 3,600 ppm. So it's already a long mine life. It's already high grade, but I think it can get, that can be extended for sure. If you go to the next slide. Graham already talked about the beneficiation and, improving that from 25 to maybe 40 or 50. But what I see as an opportunity is improvement on grade. It's already obviously high grade, but when you look at the block model and the drilling, it's an inferred resource. Basically, 600 meters out from a drill collar is classified as inferred, and if you look at some of these cross sections, you can see some of these composites kind of in that high grade upper horizon. So 4,256 lithium over 29 meters, 4,000 over 35. But you look at the block model and you can see the blocks are between 3,000 and 4,000. There's even some 1,250 to 2,000. And so I think, I strongly believe that with infill drilling, the grades are going to improve even further. And I did a little quick calculation, and I mean, I'm not saying the grades are going to increase 10%, but if the grades increase 10%, that operating cost would move down to about $3,700 per ton. If they got a 5% increase in grade, that's down to $4,300 per ton, and that's in the first 25 years. So there's still a lot of opportunity to reduce that operating cost even further. And then the last thing I'll say, you can see the block model on the right, and that's filtered for above 3,000 ppm. And you can see kind of the circle shape around some of those collars. And the reason why it stops there is that's as far as they can estimate it. If there was more data, it would be estimated further. So those areas in yellow are areas where I believe Surge, with additional drilling, can expand more of that high grade. And that stuff in the lower right, that stuff outcrops at surface. There's high grade soils down there. So I expect with more drilling there, there's going to be zero strip material at 3,000 ppm at surface that's currently not included in the study. So lots of opportunities to improve things, before the next stage, PFS or FS. Thanks.
Okay, great. Thanks for that, Steve. And so it's great comparative summary. We also talked about, PFS, DFS. So the question, from here, I guess Graham or whoever wants to answer, from a permitting perspective, there's been some acceleration, under the Trump administration, on deregulation, permitting, and the like. So what, if you could just first talk about permitting, and then we could talk about, financing.
Yeah, Howard, I'll take that one. Certainly, the Trump administration has endorsed mining and making permitting easier. It's made significant changes at the Department of Interior. They've supported the Fast 41 process that was put in place several years ago. We've been in touch with the Fast 41 people. We've been in touch with the DOE people and the DOD people as well. Trump has announced and is going through changes in NEPA, which really should assist kind of permitting going forward. Currently, we have gone through and have our exploration plan of operations permit that will allow for that drill out and infill drilling that Steve spoke about. So, we continue to stay in touch with permitting folks at the Bureau of Land Management, not only locally, but in DC as well. So I think that we're kind of well positioned to move forward on permitting when we need to in the future. As I said, we just got our exploration plan of operations permit, and the current administration is supporting fast tracking permitting generally.
Okay, great. So in terms of financing, I think there was some talk earlier in the year about a potential strategic partner kind of coming into Surge. I'm not sure exactly where that stands. Let me get you address that, and now that the PEA is out, what are your thoughts on partnering from a strategic point of view?
Yeah, thanks, Howard. I'll handle that. That's kind of a two-part question, and I'll tackle the first part first. Was the failed financing we had, the failed strategic investment, and really in a nutshell, I'll just break it down as simple as I can. It came down to a TSX position. This company wanted to invest $30 million, but they wanted a mining services contract. They mine another mineral. They wanted to learn about lithium. They're a very, very large mining company in the US. And they wanted a mining services contract, which we thought was fantastic because we don't have mining services people. It was more akin to the sawtooth agreement that LAC has. They wanted to be there for the duration and mine the project. What that involved, though, was their investment. The TSX position was that if you issue paper in terms of a private placement, the company that receives the paper and gives you the cash loses all right to the cash. And that didn't bode well for the entity who didn't want to give us $30 million and have the ability for us to terminate them the next month, which makes sense to me, made sense to all of us. And no matter how many parameters Greg and I put in to try to appease both the exchange and the investor, we just couldn't get over that drop dead line in the sand that the TSX has, that if you issue paper, that terminates that company's right to the cash and you can terminate them. So it's unfortunate. And I guess the genesis of all that is back in the old day, we suffer from some of the nefarious promoters who would set this up as they'll do a mining services agreement. They'll create paper for themselves. They'll build the company back so they get the cash. So they withdraw the cash and they get the paper, they promote it and they blow off the paper. Unfortunately, when a real deal comes along, like we had in place with the TSX, there's just no line in the sand for the TSX to budge. And hopefully at some point that'll change, but that's the genesis of why that policy's in place. And we just couldn't overcome that. So the group, the investor, said, well, that looked like a damn good deal for the shareholders, and we agreed, and they just couldn't get their head around TSX policy, and we couldn't conclude that deal. So unfortunately, that went by the wayside. Luckily enough, we were able to reach out to some key investors and secure a interim financing of $3 million, which, if nothing else happened, would allow us another year of working capital. But to follow your second part of that question about what are we doing now, now that we have the PEA out, which a lot of people have been waiting for, you can rest assured that there are other parties that are interested in this project. This is a very large, very special project. We have ongoing relationships with other parties who are interested, and hopefully we'll have a very positive outcome to announce in the next 2 to 3 months. But now we go through this process, and again, the PEA is new. These companies will go through the PEA and work with us and Graham and M3 and answer all the questions, and hopefully we'll satisfy all those questions with great answers.
Okay, so you're talking with additional strategics and hope to have something on that score within a couple of months, but that's still over the next kind of 6 to 24 months, right? As you go through feasibility study, I mean, this is a very large CapEx number. So I guess, how do you piece together the overall path to a final investment decision sometime in the next kind of couple of years beyond this prospective initial capital you might raise?
Well, I think that's a great question, Howard. I mean, what we're going to do now is we're going to focus on, we've broken down the budget. It's not 30 million. That 30 million was going to take us to BFS. We're going to, given the state of the market, we have about a $9 million budget for a PFS. And that PFS will involve further drilling, further network, further engineering. And that's what we're seeking now, is let's just tone it down a bit given the state of the markets. And we're seeking strategic investment for 10 million to get us through to the PFS stage.
Okay. And I guess, given the growing importance of securing domestic critical minerals, how are you engaging, with U.S. policy initiatives, OEMs, government funding mechanisms. You mentioned you're in talks with the Fast 41 and the DOE. I guess like what but it is a new administration. Any comments on that would be
Right.
great.
As I said, we've been in touch with DoD folks and the DOE, and as you know, Howard, I mean, the new administration is just continuing to still work on their policy framework and funding. On the DoD side of things, the programs that they had are fully funded right now, and they don't have any kind of money available. And the DOE programs from the Loan Administration Office, of course, are for constructing above ground mining operations. So we're a little early for that. Nonetheless, we have been to DC. We've talked to folks in those organizations. We've got other contacts there, and continue to have those discussions. I mean, what's important, about this PEA, it's what we can use to kind of lever a lot of relationships that we do have in DC, and really, bring Surge to play with multiple legislators and the bureaucracy there. And so, with this PEA now, it's kind of like our coming out party for DC, and we really expect to ramp that up even further over the next few months.
Okay, I mean, and that's great. I mean, having observed, Washington D.C. for, I've been doing lithium for 15 years with, Lithium Americas Thacker Pass being the first project, that I looked at, from 2008 to, 2016, I guess, initially. And the knowledge now, the path that they went through, right, from an education point of view, the government has seen a lot of clay projects, right? So they'll understand, I think, the economics of your PEA and how, as Steve, laid out on a relative basis, the robustness of the economics of it stack up. So in terms of getting comfortable with the economics, and which companies to bet on, I think you'll have second or third mover advantage, I guess, in that respect. And I guess finally, Graham, beyond the $9 or $10 million that you're looking, short term, GM's in Thacker Pass, Ford's and others are in Ioneer. What's your, do you think that those will be, part of the picture, or might, I've noticed some of the, Google signed a deal, to build nuclear plants where they're not just off taking, but actually investing in project development of 3 nuclear projects. So I'm just wondering if they may get involved in kind of solar plus battery projects and then realize, we need to get the raw material in the same way that GM, said we need to get the raw material for their batteries. Anyway, so just what are you hearing, or maybe oil companies or others? Yes, it's a down market, but there are a lot of new and different, players in the industry, and Rio Tinto obviously is very much focused on long run. They in their investment in Chile, they reiterated that they see lithium growing 10% a year for the next 15 years, right? So that's 3 times global GDP. There's very few industries like that. And if you translate that into how many tons are going to be needed, if you go into 29, 30, 31, an extra 150, 200,000 tons are going to be needed every year. So that's two or three surges will be needed in the market. So what are your thoughts, I guess, just on, the types of strategics? So is it a mining company? Is it an auto OEM? Is it a hyperscaler, Mag 7 company, oil company, or something else?
Well, in that case, I'm listening to that, Howard, and I mean, you just make the case for this project. The fact that demand will continue. I think it's key to note that this is a domestic project. This is based in America. There is minimal production in America, and I think with current administration, one of these OEMs, just like Ford and GM have done, are going to need domestically sourced lithium production. It's our job to show them that this project is the best lithium project, and I think this PEA will attract any number of one of the companies and types of investments that you just mentioned. I can't really disclose who we're talking to at this time, but you can, rest assured that this PEA is making waves in the community, and people, if you want to be involved in lithium projects, why would you want to be involved in the 5th, 6th, 7th, 8th best one when, you know, right now we own 100% of it and it's an open slate, and we're looking forward to developing a relationship with an end user or whoever it may be. I think this project, as sure as I sit in this chair, will attract a strategic investment.
Okay. All right, I guess we'll just do 1 or 2 more questions here. I think another listener came in. Do you have an estimate of the NPV at the current lithium price of 11,000?
I think we took it down. I mentioned we took it down to sensitivity there. What was it? The lowest 15. I think we took it down to 8, which showed it was cash flow positive. So somewhere, I don't know at the back of my head what the 11,000 was. It's cash flow positive. It's not a great use of capital at 11,000. But remember, I mean, that's 11,000 today. We all know if what you're saying, if demand is increasing, you have to realize how many projects have been shelved. At some point, we're going to get to the same point in the cycle that we got to in 2020, 21, where the demand was still there and growing and the supply was restricted, and we're going to get a bump in that lithium price. Let's hope it doesn't go back to 80,000, because that's just too big a swing and it's very hard to maintain, you know, proper production profiles for companies. But at these prices, I've said before in the past, the best cure for low prices is low prices. As demand continues, like you guys have said throughout this webinar, at some point, all this supply that was supposed to come on that didn't is going to create a shortage of supply and a big demand shortfall here in sometime in the future. And I think it'll happen sooner than later.
That sounds good. I think I don't have any more questions here unless anyone else wants to chime in with final thoughts.
Oh, I think we're good, Howard.
I would have ended it after Steve's presentation.
Well, I guess with that, I'll thank everybody for taking the time out of their day to listen to the panel and the presentation. We hope that we've provided you with a good overview and a little bit of detail on PEA, and with the help of Howard and Rodney, some larger insight into the market. And yeah, we look forward to continuing work on this project and being successful in the long term. Thanks very much.